I get a lot of questions about opportunity zones, buying properties or investing in opportunity zones. And correct me if I'm wrong, but my understanding of opportunity zones is they really don't do much for us mere mortal investors looking to buy a single family or a fourplex or even a small apartment building because you have to double the basis. So basically, minus land value, you have to double you have to spend as much as you paid for it in improvements, and for most properties that's just not feasible, and so there's really no tax advantage whatsoever in an opportunity zone to sort of your normal mom and pop investor buying small apartment buildings or anything from 1 to 15 units. Is that kind of your thoughts as well, or do you have any feedback, or have you seen any strategies there that make that useful?
Sure. So I think there's a lot of misconceptions surrounding opportunity zones. I think that, so you're absolutely right that you have to what's called substantially improve the property. And essentially what that means, like you said, is that you have to double the building's basis. So I'll keep it super simple and just do a single family home that's worth $100,000 that you paid $100,000 for. So the building value in a case like that is typically about 80% of the purchase price. Of course, that does vary based on where you're located, but so we'll call it $80,000 to actually buy the home, the actual structure. So then you would have to spend $80,000 in renovating the house for you to even qualify to have that property qualify as opportunity zone property. So you really need to have a strategy that is going to be able to identify and acquire and renovate really rundown properties for this to work. Where I've seen it work, and I think it takes, again, a really complex business model, are like completely vacant, large multifamily buildings. So like I've seen like a 40-unit building that literally was boarded up. Something like that might make sense because you could spend a ton of money, of course, fixing that up and renovating that. Another common misconception about opportunity zones is that kind of all the capital gains tax just goes away. So if you have a large gain from a stock portfolio or something like that, maybe it's crypto with kind of all the crazy things going on now. It's helpful in the sense that it defers your tax until 2026, but it's not just going to go away forever. So to kind of keep things short and concise, opportunity zones make sense for a very select group of people. It's the ones that I think have a really large amount of gain, but they also have a business model to implement a strategy that they're really finding really rundown properties.
Yeah, that's actually a great point. And I hadn't really given it thought from that perspective, but the key is to buy a really cheap property that needs a whole lot of work so that you can spend that full amount spend the basis on improvements.
Right. So I have clients that will buy like vacant land or land with like a really rundown structure on it, something like that, where it's really more of a development project than anything. Stuff like that works. But yeah, it's a very interesting situation, but it's a good problem to have, of course, sitting on a large capital gain, because that's really the only situation where it makes sense to even start looking at it.
For your investor just starting out, a lot of the people on the calls are here to learn. Jordan, I do see your hand. I'll get you next. What are some like bookkeeping best practices? Like I just bought my first duplex, in 2021. I know I'm going to have to do my taxes next year come tax time. What should I be doing now to make that easy on my CPA, to minimize my tax burden? And, how do I track one-time expenses versus depreciation? And, what are some best practices there? Should I be using QuickBooks? Is there something better? Just sort of 101 starting out with a new property and a new investor. What are some advice you'd give?
Absolutely. So it really all starts with choosing the type of software that you'd like to use for accounting. So our general rule of advice is that anywhere from 1 to 4 units can probably be handled on a good Excel spreadsheet. And we actually have one that is built out that I'm happy to send you guys. So if anyone would like that, just shoot me an email, and I'm sure Jeff has it, and we'll give it out at the end of this. But so I think for 1 to 4 units, an Excel is great. 5 plus, I think you start getting into a situation where if you have a third party property manager, you probably should start using QuickBooks to keep a handle on things. The reason why you use QuickBooks over just relying on the property manager to deliver you statements is that there typically are a lot of expenses that, well, not a lot. There are expenses that are not covered or within a property manager's normal scope of work or their normal agreement with you. So for example, I pay all of my insurance, I pay all of my taxes, and I pay all of my mortgage payments. So those 3 areas are really large parts of my business that I really need to have a good pulse on at all times. So what I do is I will take the statements from my property manager, Jeff, of course, and I will then import them into QuickBooks. I will add my other bank accounts that are not necessarily associated with the property management software, and I will categorize my mortgage, taxes, insurance. Maybe I had some business meals or travel, things like that. Um, and at the end of that, I try to generate a profit and loss statement that looks very much like the IRS Schedule E. The reason why I do that is because it makes tax time super simple. So it's just a good way to save yourself a lot of headaches and stress come tax time if you do these things throughout the entire year. And it becomes really manageable if you take it month by month instead of year by year.
Jordan, go ahead with your question.
Thanks, Taylor and Jeff. Really appreciate this. This is good stuff. Understand your point, Taylor, about the qualified opportunity zones where you really have to find a distressed property to make it worthwhile. But my question is there really any downside to investing in a QOZ? If, for example, you just happen to find a property that looks like it'll cash flow in a QOZ, and otherwise it looks, pretty decent. And the tax benefit would be nice, but that's not really your prime reason for wanting the property. Is there some reason from a tax standpoint you should avoid that?
No. So if you find a deal that works and is in an opportunity zone, and you have the capital gain to be able to contribute into the deal, from a compliance perspective, opportunity zones actually are not that complicated, which is great. So on your tax return, they have a form that actually lets you self-certify as an opportunity zone fund. If you have 90% of the property in the LLC or partnership as opportunity zone property, it qualifies. And of course, there are other tests, as we mentioned earlier, that if you're renovating, it has to essentially double the basis. But again, if it works as is, then great. I mean, it's a benefit that you should take advantage of.
Carmen, you can go ahead.
Hello. I have a question about the 1031 exchange.
Sure.
Can a buyer go from 2 properties down to 1 if the dollar amount is the same?
Sure. So the general rule of thumb for an exchange, and you could really do whatever you'd like on a 1031 exchange, but the rule to avoid tax is that the investor does not want to take any cash out at the end of it. So I'll just give you a really high level example. If I sell a property for 200 and I buy a property and I do a 1031 exchange for 150, there's a good chance that I'm receiving what's called taxable boot at the end of it, because there's obviously an excess from the purchase price that I sold for than what I acquired for. So a good rule of thumb is that you always want to acquire at least equal or greater to your purchase price. I really like to go even higher than that and say that if you can take your equity from the initial sale and leverage that up a bit, it really helps your depreciation benefits. So I like to always acquire more than I originally sold for. But that's a side note. To answer your question, you can go from 100 properties to 1. You can go from 1 properties to 100. It doesn't make a difference of how many. It's just following the rules that if you sell properties within a certain time period and you deposit it with a qualified intermediary, you follow all rules to close on the replacement property within 6 months. It doesn't make a difference how many properties, and it doesn't make a difference on what type of properties either, as long as it's real property, which is real estate.
Okay.
And Carmen,
thank you.
Carmen, I'll just add to that, that the one challenge I see in especially trying to acquire multiple properties is inventory being as tight as it is. There are very strict identification timelines and then closing timelines. So you have to identify your candidate properties, your replacement properties within 45 days of closing on the relinquished property. And there are certain rules with regards to how many and what kind you can identify as possible replacements. And then you have to close on all of those within 6 months. And so the one potential pitfall of trying to go from one property to two or three is if property number three, the deal falls through because of a bad inspection or any number of reasons that a deal cannot get all the way to closing. Now you're stuck there, you're outside of your identification period, and you're going to have to pay tax on the boot for the third property or fourth property, which, whatever didn't close within the time frame, you're kind of stuck with that gain. And so, like Taylor said, you can do it, but the challenge is you have to identify them within 45 days and you have to close within 180 days. And there are no exceptions to that timeline. So if one of those multiple properties doesn't close, you're stuck paying at least some tax.
Okay, that makes sense.
Taylor, you mentioned something that piqued my interest and I think is relevant to a lot of our clients because a lot of people live out of state, but buy real estate in Florida. And you mentioned, I have to add in my travel expenses. In your opinion as a CPA, what is a realistic spend? What's a realistic number of trips to Florida for somebody that owns property here and wants to come once, twice a year to check on their rental properties, meet with their property manager, whatever the case may be? How closely is the IRS watching that? And what is realistic in the eyes of the tax man?
Yeah, so a really good question. There is some subjectivity to it for sure. But the general rule of thumb is that if you're spending more than half of your time on a business trip, on real estate related activities in that location, that it is tax deductible. And a really other interesting rule about that is that if you fly somewhere on a Friday, so just for example, you fly somewhere on a Friday, you work 5 hours on real estate. You then have Saturday and Sunday that are the weekend, and you also can work on Monday. The weekends actually count as business days because they're weekends. So it's a really nice rule to kind of stack your trips around weekends because they are counting as business days. So as long as you're spending more than half of your time, I think it's a reasonable expense to take. And what I mean by that is, are you meeting with your property manager when you go down? Are you going to tour your properties? Are you looking at vacant units? Are you meeting with your attorney or your title company? As far as what's normal, it really depends on the size of your portfolio. So personally, I like to go down 4 to 6 times a year. And I think that number could probably hold true for anyone that's got more than a couple of rentals. So just totally reasonable as long as you can substantiate that you are working at least half the time on business days.
I know a lot of people teach and a lot of investors strive to qualify as what the IRS calls a real estate professional, a full-time real estate investor. And there are some substantial tax benefits that go along with that.
Sure.
For folks that may not be familiar with that designation or whatever it's referred to and what it means to you from a tax standpoint, can you give a quick real estate professional status 101?
Sure. Yeah, so I wanted to focus on the use of real estate losses on this presentation. So I think real estate, a professional, kind of ties in perfectly to that. So as you guys, of course, are aware, real estate is an asset that has what's called depreciation expense attached to it if the property is in service. So generally what winds up happening for the average a performing rental property, so you're one that's generating standard returns, even though it's generating positive cash flow, come tax time, you generally are showing break even or a loss. Now, what you can do with these losses really depends on a couple different situations. So if you make less than $100,000 a year, you are able to use these losses against other active income up to $25,000. So for example, let's say you have a W-2 job that pays $70,000. You have a loss of $15,000 from 3 rental properties, let's say 5,000 each. You are able to actually offset that 70K with the 15K of losses for a total income of 55,000. So really simple math. Obviously, there's some other assumptions in there, but that in itself is the most powerful tax benefit of real estate. Now, what you're probably saying, of course, is there's obviously other situations that are around, and if you make between 100 to 150, it's phased out. So for every dollar, every $2 of income, a dollar of loss gets phased out of that 25,000. So that income level is kind of in this like weird middle ground that like you're able to use some, but you're not able to use all. Now,
Taylor, can I just jump
Sure,
in for 1 second? And I just want to point out that having $5,000 of losses on a rental property, that doesn't mean you're cash flow negative.
Right.
You could be making money every month, but from a tax perspective, after depreciation and things like that, you're actually, well, you're taking a loss in the eyes of the IRS, but it doesn't mean you don't want to look for poorly performing properties that you're throwing money into every month. You can be cash flow positive on a monthly basis, but still take a loss in the eyes of the IRS. And that's really kind of the sweet spot.
correct. Absolutely. So now I'll get into my third out of fourth scenario. The third scenario is that you make over $150,000 a year, married filing jointly, or single. Actually, the limit doesn't change. So a fairly normal situation, for example, that you have a working family with 2 incomes, something like that. All rental activity is typically treated as what's called a passive loss. So if there is depreciation, sorry for my dog barking, I have a package at my front door. So if there is depreciation and it is creating a loss, and you make over that threshold, the loss is actually suspended and carried forward until you either have passive income to offset it. So if your rentals are producing income at some point later down the line, or if you sell the property and dispose of it, then you're able to use those losses. So this becomes really tricky because if you're a high income earner or you have a 2 income household, et cetera, you can keep generating losses and not actually be able to use them against your other income. So it can keep carrying forward indefinitely until you have passive income to actually offset it. There is one exception to the rule that Jeff alluded to earlier that makes this tax strategy really powerful, and it's called the real estate professional status. And essentially what that means is that you are electing to treat your properties as a trade of business, as a trade or business, and it's no longer passive. So it's an active business for you. And essentially what you have to do to qualify is spend more than 750 hours on your real trade or business. So you are able to aggregate all rentals together. So to spend 750 on real estate, you can unfortunately have 1 or 2 rentals. Even self-managed, it's something that is it's really hard to actually achieve. And this is an area that's heavily scrutinized by the IRS, and it's not something that I'd recommend messing around with by any means. But if you have a portfolio that's a little bit larger and you are very actively involved in the management of the properties, it is possible to hit that 750. The other requirement is that it's more than half of your time. So what more than half of your time means is that if you have a W-2 job and you're working 2,000 hours, you unfortunately have to work 2,001 on your real estate to be able to qualify. So the absolute bare minimum that you can have a job, have a different job and still qualify is 750 and then 751. So really interesting stuff there, but kind of the takeaway from that is that if you have a W-2 job, it's virtually impossible to qualify. So I am a partner at my CPA firm. Even though I have 100 units, I don't even qualify because it's not more than half of my time. But anyway, if you qualify, you are able to take your losses against all other active income without regard to any of that income limitations that I was talking about earlier. So, for example, if your spouse works, they have a W-2 income of $100,000 a year, your properties generate a $20,000 loss, and you have I don't know, a property management business, you're flipping a bunch of houses, or anything like that, you're actually able to offset all of that income with your rental losses. So it's a really powerful tool to be able to take advantage of these losses.
And Taylor, correct me if I'm wrong, but I think where most high wage earners with W-2 jobs might be able to take advantage of this is if they have a spouse that maybe doesn't work, but they become sort of the ringleader of the real estate. Maybe they get their real estate license, they do a few transactions, they manage their rentals. And so you've got one spouse who's a physician earning 300K. You've got the other spouse who stays at home, manages the real estate, and meets that 750-hour criteria, which if you pencil it out weekly, it's nowhere close to a full-time job. And then you're able to offset your active W-2 earnings with your passive real estate losses.
Yeah. So there's two really popular scenarios. The first one is that one spouse works and one spouse stays at home. So like Jeff just mentioned, you have a high earning person number one. Let's say they make $300,000 a year, so they're easily over that 150. But you have someone that's able to spend 750 on rental properties. If you can generate loss, easily offset against that income. So it's super powerful for high earners. A second scenario that's for a bit more experienced investors is that they're generating active income from managing real estate. So you have property managers, you have people that are doing multifamily syndications that they're raising money for buying a big property and they're collecting fees. All those kind of fees are ordinary income, like a W-2 job might be from a tax perspective. Then you have this real estate that actually you own it now and you generate loss, they actually can offset each other. So those are the two most common scenarios. So yeah, it's really powerful, and I think the ability to generate losses, and then secondly, how you use those losses are probably the most powerful tax deduction that real estate offers. 1031 exchange being a close second.
And really where we tie this all together is the infamous needle in a haystack value add property, where you're going to take this rundown Class D or Class C property, invest $80,000 into it to turn it into this well-performing Class B property. A lot of that $80,000 investment you can write off as a loss in year one if you are a real estate professional. So it has huge tax implications for anybody who's in that scenario with maybe a high earning spouse and a stay-at-home spouse or something along those lines. So it really is huge from a tax perspective. Mark, go ahead with your question.
Hi, thanks for doing this. Really helpful information. How do there's a formula to understand the depreciation for your property. And I think the value of the property is not the market value that someone is going to offer if you were to sell the house, but it's the value that's registered with the county officer. So if you can just throw a little bit more light on that, that'll be helpful. And then the second question, which I'm tempted to take the offer now, is if you can share a little bit more about how you scaled up to 100 units, that'll be helpful as well.
Oh, absolutely. So yeah, so a really good question on how depreciation is calculated. So the first thing you need to know is that depreciation on a residential real estate asset, so it could be a large multifamily all the way down to a single family home, is depreciated over a 27.5-year schedule. So what that works out to being is roughly 3.5% to 4% each year as a depreciation deduction. And what is depreciated is only the amount of the building, not the amount of the land as well. So you were really close in saying that it's only based on what the county is saying, I think what you were implying is that the county has an assessed building value and then it has a total value. So you only take the assessed value. That's one way of calculating building value. The IRS in the code, there actually is no strict rule on what land value should be. They actually use the word reasonable, which I find fascinating. But a good rule of thumb is 80%. So if you buy a place for 100K, it is totally reasonable to assume in most markets. I mean, if you're in New York City or San Francisco, that's a whole different story. But if you buy a place for 100K, take $80,000 as your building cost and then multiply that by 4%. And that is typically what your depreciation deduction looks like. So that is a really good way to estimate. On a more complex topic that I'll just touch on briefly is that there is something called cost segregation that actually breaks out the class life. Instead of 27.5 year, it might say, well, your driveway is actually 15-year property, and that's eligible for bonus depreciation. So it's really 100% of the cost. It's not 4%. So there are ways to get that 4% number up, depending on the investment. But kind of when you're modeling out this stuff, typically 4% is what I use to just say, okay, here's what's going to generate that loss for me. How much profit can I have that's essentially tax-free?
Thank you very much, Taylor. I actually do live in San Francisco Bay Area, so I'm going to go to the county officer's office website and look at the value of the building, right? That's safer for me, right?
Yeah. So I was just working on a client that has commercial real estate in San Francisco actually yesterday. And the land value that I was using was, I believe, 36% of the purchase price. Now it's one particular commercial office building in one part of town, but you get an idea that it's typically not 20%, it's typically more like 30 to 40%. But again, in the code, words reasonable, as long as you have some support for it. So whether it's an appraisal, a county website, you should be fine.
I did put it in the chat section, but if you want to read more about Taylor's journey to 100 doors, I think he shared some really interesting nuggets of wisdom in that interview that we did, and you can find that at copelandmorgan.com/blog. That's the most recent post on our blog, so I highly encourage everyone to check that out. If you have specific, more personalized questions for me or for Taylor, you can shoot me an email and I can put you in touch with him. If nobody else has a hand up or anything in the chat, I just want to thank Taylor for his time. Thank you all for participating, and look forward to seeing you.